So here's, I think, the tricky situation with the Fed. Markets have priced this in. And if the Fed decides, and they have to decide very soon, is the China trade deal going to get done? What type of pressure does that continue to bring to the markets? But if they decide not to bring on any rate cuts, if they think the economy is in a good place, they have to very artfully craft their language over the next few meetings to backtrack both markets to now price in no rate cuts, right? When you have had that already priced in for quite some time now.
What is the risk, though, of misreading the bond market? Now, you guys talk a lot about it on Fast Money because if you just looked at yields, you'd say that the bond market is pricing in the potential for a slowdown.
Right.
But with a negative yield on German debt, I also wonder, is there just a huge amount of buying of U.S. Treasuries, not because we're slowing,
right,
but because there's no place else in the world to get any kind of return?
Yeah, which is true. I mean, you look at our 10-year yields, it's very comparable to almost a 10-year Italian debt yields. Now, in a lot of the negative, yield situations with sovereign debt, a lot of central banks have to buy debt of other countries, a lot of pension funds, a lot of insurance companies. So they're forced to buy these debts. So you don't have retail clients that are choosing to buy negative yielding debt. But you're right. When you compare U.S. rates, they look fairly attractive compared to other developed nations' yields.
Michael, there had been a longstanding belief amongst investors that this is the stock market president, that eventually he would step in and not let the stock market slip too much. Given what you heard from Larry Kudlow and from the president yesterday on Squawk Box, I'm wondering if you still believe that is the case, or if they're going to go full steam ahead in terms of taking a more aggressive stance with China and perhaps not getting that deal that the market is so hoping for.
Well, it's a great question, Melissa. I think he is the stock market president in that they understand the stock market and how to use it. And I would probably take a broader, higher level, 35,000-foot view of a lot of this, where they know the market, they know the U.S. economy is in good shape. That's what they've represented. Statistically, the data confirms that, at least for the most part. And as long as that continues, the stock market has a better foundation to continue to build gains. They can use that as leverage with respect to the trade negotiations. And I think part of the, Larry mentioned the lack of inflation as a reason why you might be able to cut rates in this environment. And that may be true. Our inflation studies would indicate that it's probably a little understated, and I'd be careful with that argument. But I get it. The issue would be, though, I see a lot of the Trump bashing of the Fed as almost a negotiating ploy with respect to what's going on with our various status of trade negotiations all over the world, specifically China, but you could easily apply it to other regions of the world as well. Europe, England, even the U.S., Canada, Mexico. So I see it as a larger picture here. And while Trump may want lower rates, I mean, what president doesn't want lower rates? I mean, and that's generally good for the stock market. So that's kind of a generic sort of wish list, if you want. I see it at a level that's more playing into or intersecting with the ongoing trade negotiations.
Nisha, very quickly, is it possible as a fund manager to either measure or value the effect of a prolonged, let's say we don't get a deal, a prolonged trade war with China on equity valuations?
Yeah, well, so my sector being municipal bonds, I think the impact on that could be, how does this affect states and municipalities in the long run? So you have certain states, certain local industries that rely very heavily on imports from China. So look at the auto industry, for example, in parts of Michigan. If that starts becoming a case where companies can't absorb the cost, the higher cost, they can't pass it on to the consumers, you start seeing increased layoffs. You start seeing overall less tax collections over the longer time period, and that's going to negatively impact these local credits in these states. California's economy is certainly very cyclical, a decent amount of reliance on imports. I know Mexico is out of the equation for now, but, you had a lot of states in the long run that can be affected by this. So we're taking this all into account when we're looking at it on the fixed income and specifically on the muni side.
All right.